In the next review in risk and investment management, we'll try to understand the portfolio risk using various methods. So diversified VaR is the VaR that we've been calculating hitherto. So it is the VaR of the portfolio where the calculation takes into account the diversification effects. Individual VaR, on the other hand, is the VaR of an individual position in isolation. So please recall the calculation of the VaR. The VaR, assuming the expected return is equal to 0, would be the z-score multiplied by the standard deviation multiplied by the value of the portfolio. And way the standard deviation is calculated will take into account the correlations amongst the various assets. So Z is the score associated with the level of confidence. The Z value generally comes from the normal distribution. So in the diversified VaR, the standard deviation will be the standard deviation of the portfolio taking into account the diversification effects. In case of individual VaR, the VaR will simply be, the Z-score will remain the same, but it will be the standard deviation of the individual asset multiplied by the amount invested in that asset. That is the weight of that asset multiplied by the total portfolio value. The total VaR of the portfolio, as you will see soon, will be less than the sum of the individual VaRs because of the diversification benefits. Now please recall the standard deviation for an n asset portfolio can be given as the summation of, rather the double summation, I equal to 1 to j, 1 to n, or j equal to 1 to n, wi into wj into covariance of I comma j. For a 2 asset portfolio, this formula will become that the standard deviation of the portfolio is equal to wa square into sigma a square plus wb square into sigma b square plus 2 covariance of a and b into wa into wb, which can be written as 2 into the correlation into sigma a into sigma b into wa into wb. And this will actually be the variance of the portfolio. If we take the square root of the variance, we will get the standard deviation of the portfolio, and if we multiply it with z and the value of the portfolio, we will get the VaR of the portfolio. So it can be proven that the VaR for a 2 asset portfolio will be given as the VaR of asset A plus the VaR of asset B plus 2 into the correlation into the VaR of A into the VaR of B. It's fairly straightforward. If you multiply both sides by the portfolio value and the z-score, then we will get the VaR of the portfolio, which will become wa square sigma a square z square into p square. That will be nothing but the VaR of a square plus the VaR of b square plus 2 into the correlation into VaR of a square into VaR of b square, whole under the square root. So let's apply this formula and calculate a few questions. An analyst computes the VaR of the 2 positions in a portfolio. VaR of portfolio 1 comes out to be $2.4 million, of portfolio 2 comes out to be $1.6 million. Compute the VaR of the portfolio if the returns of the 2 assets are uncorrelated. So using the same formula, the VaR of the portfolio will come out to be VaR of asset 1 square plus VaR of asset 2 square plus 2 into correlation of war of asset 1 into war of asset 2, which will come out to be, correlation is given to be 0, so this will be 2.4 square plus 1.6 square the under root, which comes out to be $2.88. So please verify the war of the portfolio will come out to be approximately $2.88. Similarly, the analyst computes that the war for the two positions in a portfolio, wars are same. The returns now are perfectly correlated, or the correlation is equal to 1. So in the same manner, plus 1.6 square plus 2 into the correlation, that is 1 into 2.4 into 1.6. Please note this will simply come out to be 2.4 plus 1.6 the whole square, or the war of the portfolio will come out to be 4 square the square root, that is 4. So if they're perfectly correlated, then the war will be a simple summation, that is there will be no benefit of diversification. Please note that we proved in FRM part 1 in foundations of risk management that if the portfolio is equally weighted, that is all assets have a weight of 1 by n, and all individual positions have the same standard deviation of returns, and the correlation between each pair of returns is constant, that is every asset is correlated with every other asset to the extent of rho. This is also called the average correlation. Then the variance of the portfolio can be given as the variance of the individual assets into 1 by n plus n minus 1 upon n into rho. And then we proved that as n becomes large, this term will tend to 0 and this term will tend to 1, or the variance of the portfolio will be more or less the same as the covariance of the, or the average covariance of the assets. N is the number of positions, sigma is the standard deviation that is equal for all of my stocks or all n positions, and rho is the correlation between the returns of each pair of positions. Please ask for the FRM part 1 video on foundations of risk management if you want to see this proof. If a portfolio have 5 positions of $2 million each, the standard deviation of the returns is 30% for each position. The correlations between each pair of returns is 0.2. Calculate the war using a Z value of 2.33, that is corresponding to a 99% war. So let's first calculate the standard deviation of the portfolio, or rather first calculate the variance. That will be the standard deviation of the return of each position, that is 0.3 into 1 upon n plus n minus 1 upon n into the correlation between the assets, or the average correlation, which is given to be 0.2. So this will be the variance of our position. The standard deviation can be calculated as the square root of the variance, which will come out to be 0.18, or we can calculate the war as 2.33 into 0.18, that is sigma, into the value of the portfolio, that is 2 million into 5 positions each, that is a total value of $10 million. So the war will come out to be about $4.194 million. Now a very important concept is that of the marginal war, very likely to be tested, this concept, and a very important concept, so please understand very well. Marginal war is the change in a portfolio of war that occurs from an additional 1 unit investment in a given position. So if we have A, B, C, D, let's say 4 stocks in our portfolio, then the marginal VAR of position A will be calculated as the increase in the VAR from a 1 unit increase in A. Similarly, marginal VAR for B can be calculated as the increase in VAR for a 1 unit increase in the investment in B. So it is the slight change in the VAR of the portfolio for a slight increase in a particular investment I. Now please note, you do not need to know how this proof comes, however you do need to remember the end result. So the marginal VAR can be calculated as the z-score multiplied by the covariance of the asset with the portfolio upon the standard deviation of the portfolio. We can break this formula as z into the covariance can be written as the correlation multiplied by the standard deviation of I multiplied by the standard deviation of P upon the standard deviation of P, z into the standard deviation of P into the standard deviation of I into the correlation upon the standard deviation of P. The second term is nothing but the beta of the asset I. The first term, if we multiply it with P and divide it by P, then P into Z into the standard deviation of the portfolio will be nothing but the VAR of the portfolio divided by the value of the portfolio into beta I. So please note, both formulae for the VAR you need to remember. You can derive one from the other, however it's not a very straightforward and quick proof. You may have to think a little bit. So it's better that on the exam you remember both the formulae individually. So the marginal VAR, that is the increase in the VAR for a 1 unit increase in the investment in a particular asset, can be calculated as the z-score multiplied by the covariance of the asset with the portfolio upon the standard deviation of the asset. Or the marginal VAR can also be calculated as the VAR of the portfolio divided by the size of the portfolio multiplied by the beta, that is the beta of the stock with the asset, rather with the portfolio. So let's do an example and understand. Assume a portfolio has a VAR of $400,000. This portfolio is made up of 4 assets, A, B, C and D. The assets are equally weighted with a value of 1 million. And asset A has a beta of 1.2. So in this case beta is given, so we'll apply the beta formula to calculate the marginal VAR. That will simply be the VAR of the total portfolio, that is 0.4 million divided by the value of the portfolio, that is 4 million, multiplied by the beta, which is given to be 1.2. So the marginal VAR of asset A comes out to be $0.12 million. So the portfolio VAR will change by 0.12 units. My apologies, not $1 million, it's 0.12 units for every €1 change in asset A. So €1 increase in the investment will increase the VAR by 0.12 units. Incremental VAR is the change in VAR from the addition of a new position in a portfolio. So if I have A, B, C, D and I add an asset E and some amount of asset E in the portfolio, then what will be the change in the VAR of the portfolio? So to do the precise calculation, we will have to first calculate the new VAR and then subtract the old VAR, and this difference will be the incremental VAR. However, this calculation can be time consuming. That is, first calculate the new VAR after and then subtract it from the old VAR. So approximate method of calculating the incremental VAR uses the same concept as the marginal VAR that we studied previously. So we break down the new position into the risk factors, multiply each new risk factors times the corresponding partial derivative of the portfolio with respect to the risk factor, and then add up all the values. So just like we calculated the marginal VAR for the increase in asset A in the previous question, we can compute the marginal VAR for the increase in a particular risk position. Similarly, the marginal VAR or the marginal increase in the VAR if the risk position J increases, and the marginal increase in the VAR if the risk position K increases by 1 unit. And then we will see that this new asset E increases I, J, K or the various risk factors by how much. And we can then multiply that amount with the marginal VAR corresponding to each of the positions and compute the expected change in the VAR or the expected incremental VAR. It will be an approximation, but it is an approximation that will work. We'll do an example and understand this better. So once again, the incremental VAR is the difference between the new VAR from the revaluation minus the VAR before the addition. The revaluation requires not only measuring the risk of the new position, but also requires the measuring the change in the risk of all other positions that are already in the portfolio, because this new position will have some correlation with all of the other positions. For a portfolio of hundreds or thousands of positions, this would be time consuming as we discussed. So we can apply the marginal VAR approximation and try to calculate the incremental VAR. A portfolio consists of assets A and B. The volatilities are 6% and 14% respectively. There are $4 million and $2 million invested in them respectively. If we assume they are uncorrelated with each other, compute the incremental VAR for an increase of $10,000 in asset A. Assume a Z score of 1.65. So please note that we are given two assets, A and B, and we are increasing one asset itself. So the risk factors per se are not given, but the new addition is of an existing asset. So what we can do is that think of asset A as risk factor A and think of asset B as risk factor B, and compute the marginal VAR for each risk factor. That is, if risk factor A goes up by a small percentage, how much will the risk of the portfolio change by? And similarly, we can compute the marginal VAR for B. That is, if risk factor B goes up by a small or by a given amount, how much will the VAR of the portfolio go up by? The good part here is that increasing risk factor A, that is increasing asset A, has no impact on B because the two risk factors are uncorrelated. So we simply need to compute the marginal VAR of A and multiply it with 10,000 to get an approximation of how much will be the incremental VAR or the increase in the VAR. Please recall, marginal VAR gave us the amount by which the VAR of the portfolio will go up by if this risk factor or this asset went up by 1 unit. So if it goes up by 10,000 units, the VAR will go up by 10,000 times this. If this was impacting the risk factor B, that is, risk factor B was also going up because of inclusion of A, or it was coming down, then we would have had to incorporate that as well. But in this case, they are uncorrelated, so I just need to calculate the marginal VAR of A. Please note, however, it's not going to be a very straightforward calculation because the beta this time is not given. So marginal VAR of A would be given as the Z score multiplied by the covariance of A with the portfolio divided by the standard deviation of the portfolio. As a first step, let's calculate the standard deviation of the portfolio. Standard deviation of the portfolio will be given as the weight of A square into sigma A square plus weight of B square into sigma B square plus 2WA into WB into covariance of A and B. So weight of A is given to be 4/6, weight of B is given to be 2/6, sigma of A is given to be 0.06 and sigma of B is given to be 0.14. The correlation or the covariance between A and B is given to be 0. So if we substitute in this formula, we'll get sigma P to be approximately equal to 6.14% or 0.0614. We can compute the standard deviation in dollar terms also. That will come out to be 0.0614 multiplied by $6 million. That is the total value of the portfolio. Now please note, in such a situation, the covariance of A and B is equal to 0. So the covariance of asset A with the portfolio will simply be the weight of asset A multiplied by the variance of asset A. Or more generally, you can remember that the covariance of asset A with the portfolio will be given as the weight of asset A into the variance of asset A plus the weight of asset B into the covariance of A and B. Since the covariance of A and B is given to be 0, the covariance of A with the portfolio will simply be the weight of A into the variance of A, which in this case will come out to be 4 divided by 6 multiplied by the variance of A, that is 0.06 square. So if we substitute the covariance and the standard deviation in the calculation of the marginal VAR, we can derive that the marginal VAR of A will come out to be 1.65 into the covariance of A into P. Please note, if we are taking the covariance in percentage terms, then even the standard deviation we will take in percentage terms. If the standard deviation we take in dollar terms, then even the variance we will take in dollar terms, that is multiplied by 6. So this will give us the marginal VAR of portfolio A. That is, for a 1 unit increase in asset A, the total risk in the portfolio will go up to this extent. So this comes out to be, so the marginal VAR will come out to be 0.644. That is, for every $1 increase in asset A, the VAR of the position will go up by $0.644. So if we increase $10,000 in asset A, then the VAR will go up by 10,000 into 0.644, that is about $64,400. So which is what will be the incremental VAR if we add $10,000 in asset A. So once again, as an approximation, what we did is that if we increase one risk factor, we first compute the sensitivity to that risk factor, that is nothing but the marginal VAR, and then multiply with the amount that we have increased in that risk factor. To calculate the marginal VAR, we use the covariance formula. To compute the covariance of another asset with the portfolio, it will be the weight of that asset multiplied by the variance of the asset plus the weight of the second asset multiplied by the covariance of that second asset with the first asset. So Just remember this formula also, it may be needed to compute the covariance, and that will help us calculate the marginal VAR. Marginal VAR multiplied by the increase in the asset will give us the incremental VAR. Please check, this will come out to be 0.0644, and hence it will be into 0.0644, that is $6,440 approximately. Or for a 1 unit increase, this will increase by 0.01 unit increase in the asset, the VAR will increase by 0.06 units, not 0.6 units. Please verify the answer. Component VAR is the amount a portfolio VAR would change from deleting a position in the portfolio. So in a large portfolio with many positions, if we delete one position, then the component VAR can be approximated again as the marginal VAR multiplied by the amount that you have deleted, that is the weight of that position multiplied by the value of the portfolio. The sum of the component VARs will equal the VAR of the portfolio. Assume portfolio X has a VAR of 400,000 euros. The portfolio is made up of 4 assets A, B, C and D. These assets are equally weighted within the portfolio and each are valued at 1 million. Asset A has a beta of 1.2. Calculate the component VAR of asset A. So the component of VAR of asset A would be the marginal VAR of asset A multiplied by the amount of asset A that has been removed. So 4 are equally weighted, that is each has a value of 1 million. The marginal VAR can be calculated as the VAR of the portfolio divided by the value of the portfolio into beta into the size of the position, that is 1 million. The VAR of the portfolio is given to be 0.4 upon the size of the portfolio, that is 4 million, multiplied by the beta of 1.2 into 1 million will be the marginal VAR, which comes out to be, rather the component VAR, which comes out to be $0.12 million. Recall a previous incremental VAR example of a portfolio invested $4 million in A and $2 million in B. Using their respective marginal VARs of 0.064428, similarly we can calculate for B, that is 0.175388. Compute the component VARs. So again a similar calculation, it will be the marginal VAR multiplied by the value invested in the portfolio, that is 4 million in the case of A, and 0.175388 and 0.175388 multiplied by 2 million in the case of portfolio B. This is the amount the VAR will come down by if we reduce this portfolio or reduce that asset from the portfolio. Using the results from the previous example, compute the percent of contribution of VAR or percent contribution to VAR of each component. So again it will be the component VAR of A that we calculated divided by the component VAR of A plus the component VAR of B, because the sum of the component VARs gives us the approximate total VAR. So the individual component VARs we calculated, we just need to do the ratio now. So for A it came out to be 0.257 million. So 0.257 upon 0.257 plus 0.35 will be the contribution from A. Similarly 0.35 upon 0.257 plus 0.35 will be the contribution from B. So we studied three definitions, three very important definitions. First was the marginal VAR, second was the incremental VAR, and third was the component VAR. All are very important and likely to be tested, so make sure you understand the three very well. The next concept says that the portfolio risk will be at a global minimum where the marginal VARs are equal for all I and j. So if the marginal VAR of, let's say, any one asset is higher than the marginal VAR of any another asset B, then keeping the total value of my position same, let's say I have a $100 position in which there is some $10 in A and $10 in B. The VAR of A is higher than the marginal VAR of B. Will it make sense to reduce the risk? Can I take $1 out of A and put the $1 in B? I will be reducing less VAR, or rather reducing more VAR and increasing less VAR, because the marginal VAR of A is higher, so I'll be reducing more and increasing less. In all, with a $100 portfolio, my risk will go down. So the global minimum portfolio, or the global minimum risk portfolio, will be one where the marginal VARs of all individual components are the same. Otherwise it is not a global minimum. I can reduce the risk further by taking out securities with a higher marginal VAR and investing in securities with a lower marginal VAR, such that the total value remains $100 and the risk is lower. Similarly, we can prove that the optimal portfolio from a risk return standpoint will be a portfolio in which excess return to marginal VAR is the same for all assets. If one asset has a higher excess return to marginal VAR, let's say asset I has a higher excess return for the risk as compared to asset J. In such a case, the portfolio risk return profile can be further enhanced by including more of asset A and less of asset B. The portfolio will be optimal where the excess return to marginal VAR for all assets is the same.